We always look at the margin of safety and the balance sheet and then worry about the business. Peter Cundill.
Say that means for us here.
Well, that's where it becomes a projection. But,
You're speaking with me, Mr. Sardo.
well, sir, if those assets decrease by just 25% and remain on our books, that loss would be greater than the current market capitalization of this entire company.
So, what you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
Sir, I'm not sure that I would put it that way, but let me clarify. Using your analogy, what this model shows is the music, so to speak, just slowing. If the music were to stop, as you put it, then this model wouldn't be even close to that scenario. It would be considerably worse.
Let me tell you something, Mr. Sardo. Do you care to know why I'm in this chair with you all? I mean, why I earn the big bucks?
Yes.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more. And standing here tonight, I'm afraid that I don't hear a thing. Just silence.
This was a scene from the 2011 film Margin Call. When the music stops, sudden panic set in. There is a demand to cover losses or face liquidation. That moment is what we call a margin call. But what if I told you our entire country might be living through a similar moment? Before I show you similarities in this video to the current economic condition of America, first let me explain to you what is margin and what is margin trading. Margin in investing means you borrow money from a broker to buy more securities than you could with just your own cash. The amount you deposit as collateral is called your margin. Your banker then lends you the rest. This leverage can amplify returns, but also amplify risk. Because you're borrowing, you owe interest on that loan, and your equity in the investment depends on the value of your securities versus what you borrowed. A margin call happens when, due to falling prices of the securities you bought on margin, your equity falls below a minimum threshold, which is called a maintenance margin. It's required by your broker. When that happens, the broker demands you either deposit more money or additional collateral, or they may sell your securities to bring the account back into compliance. If you don't act, you can end up losing your entire investment or even owing money beyond what you originally invested because you borrowed funds. In short, margin amplifies gains and losses. A margin call is the safety mechanism, but also the trigger for forced losses. A margin call matters for individual investors. Margin calls can mean sudden, painful losses if markets drop, even if long-term you believe in your investments. For the market at large, many margin calls at once causes forced selling, which can accelerate price declines, create panic, and even lead to a broader crash. That's why margin calls or margin trading is often described as high risk, high reward. It's not for everyone. Now let's shift to the macro. The U.S. has now reached roughly $38 trillion in national debt. Think of the U.S. government as a giant investor that has borrowed not to buy stocks, but to fund federal spending beyond what revenues and taxes cover. That spending includes social programs, defense, infrastructure, and more. Using this analogy, just like a margin loan lets an investor do more than they could with cash alone, however, the leverage carries risk. As debt balloons, servicing it becomes more expensive, interest payments rise, and the maintenance margin, what the country has to keep up, grows. If the economy slows or interest rates rise, the burden grows heavier. In that sense, the 38 trillion of debt could be seen as a kind of national margin call. Unless the government tops up the collateral by raising revenues, cutting spending, or stimulating stronger economic growth, the cost of servicing national debt could force austerity, which may cause a reduce in national services such as Medicaid, Medicare, food stamps, and government spending, or other painful adjustments. Simply put, just like in your broker account, leverage works until it doesn't. Too much borrowing makes the risk of margin call consequences real for an entire nation. Now let's highlight some economic events in the U.S. that have taken place that might force the U.S. into a margin call. Fannie Mae drops minimum FICO score requirement. Fannie Mae's automated underwriting system, the DU, will remove its minimum 620 credit score requirement for new loan case files. According to the announcement, the 620 hard cutoff is gone. Instead of using a fixed minimum FICO score, the DU will now evaluate loans using a comprehensive set of credit risk criteria, meaning underwriting will rely on a broader and potentially more subjective of borrower risk. This isn't just a technical detail. A rigid credit score floor has long been one of the main screening tools to keep higher risk borrowers out. By removing it, Fannie Mae is opening the door for more borrowers with lower or non-traditional credit histories to get mortgages. That broadens access, but it also increases the risk that loans go to borrowers with weaker credit financial stability. If many such loans default, this could ripple out to home prices, lenders, and the broader economy. Historically speaking, loosening underwriting criteria has been one of the major factors that contribute to past house-related crises, which is similar to the 2008 great financial crisis in America that happened when banks were giving loans to undeserving borrowers. This is a similar situation that might take place in the near future. Fed quietly signaling trouble ahead. Powell injects $29.4 billion into the banking system, the biggest repo operation since 2020, as U.S. bank reserves crashed to $2.8 trillion. This injection was meant to ease tightening funding conditions in short-term markets, a signal that liquidity was drying up, especially for smaller banks or riskier parts of the system. When bank reserves drop and the central bank has to step in with large overnight cash infusions, it implies that the financial plumbing of the system is under strain. That can lead to more expensive or less available credit for businesses and consumers, potentially choking off spending and investment. If borrowing dries up, economic activity can slow sharply. For a large economy like the U.S., widespread liquidity stress can tip things towards a downturn. Trump aides raise recession fears and point fingers at the Fed. Scott Bessent and other aides close to Donald Trump are expressing deep concerns over a possible recession and pointing to economic headwinds tied to the decision-making of the Fed. When political insiders publicly raise the possibility of a downturn, it can become a self-fulfilling prophecy. Businesses may freeze, hiring or investment. Consumers may tighten spending, which further slows growth in the economy. Combined with stress in housing finance and banking liquidity that's drying up, this adds to a structural risk rather than a blimp on the map. As we wrap up part one, think about what we just walked through. The Federal Reserve, the institution that's supposed to be the backbone of financial stability for the U.S., is quietly injecting $29.4 billion into the banking system, the biggest one-day repo operation since the 2020 crisis. That's not normal behavior. That's not routine maintenance. And that's not a fire alarm. Banks don't run to the Fed for overnight liquidity unless they're strained. Reserves don't fall to 4-year lows unless there's pressure building under the surface. And when the Fed injects cash this aggressively and this quietly, it's because something behind the scene is breaking. But here's the part that should concern every American. Even political insiders are starting to speak up. People close to the highest levels of government, individuals who see the dollar before the public does, are now warning about recession risks. They're pointing directly at the Fed. They're voicing concerns about slowing growth, fragile consumer spending, weakening credit markets, and the possibility that the economy is headed towards a wall. And when insiders start talking, it means the situation has already progressed further than we think. So ask yourself, why should the Fed be injecting emergency liquidity while making policymakers whisper about recession? Why would bank reserves be plunging at the same moment mortgage standards are being loosened? Why do all these events, repo injections, political warnings, shrinking liquidity, credit stress line up now at the same time? Because these aren't random headlines, they're signals, they're warnings. They're the early tremors before the earthquake. And if we ignore them, we may look back at this moment as the last clear signal that America was headed into an economic downturn that could have been seen coming, but wasn't taken seriously. Stay aware, stay informed, and prepare because the signals are getting louder, and the storm the Fed is trying to contain cannot stay hidden much longer. Please like, comment, and subscribe. Peace.